All right, so this session is on the growing role and impact of climate finance, based on the premise that from all of the international analysis that's been done, we need about $100 trillion of investment over the next 25 years if we're going to stay below 2 degrees centigrade. There isn't enough tax dollars out there to get there. We need to attract private capital to work with the government to make systemic changes in how the finance markets work and to put a premium on financing instruments that will reduce carbon. I have two incredible panelists with me here. Ms. Barnes, Tavia Barnes, is the executive director of the California Infrastructure and Development Bank, which she would be way too modest to tell you this, but I've been in state government for 30 years. It was a quiet backwater of state government until she took it over a few years ago. And now they are doing some wonderful financings and stepping up. They have a clean energy center and really becoming a major player in this area. Before that, Ms. Barnes, who is a practicing attorney, was counsel at Bank of America. She was involved in the regulation of the banking industry in California. And in addition to that, it's just a wonderful human being. I'll just leave it at that. Mr. Schaefer, to her right, is a deputy treasurer in the Office of State Treasurer John Chiang with a long and distinguished history in municipal finance. He was a he was a bond trader in New York for Chemical Bank, worked for the legendary treasurer in California, Mr. Jesse Unruh, for whom the existing Treasury building is named after, and currently runs the investments division for the state of California, which invests the money on short-term basis, the public finance division, which sells the bonds for the state, and the cash management division, which when all of the sales taxes and everything that you guys do, they calculate how much money the state actually has to spend. So with these two panelists, we're going to discuss the role of both the public and the private sector in financing climate mitigation, resilience, and adaptation. So the first question I have for Mr. Schaefer would be, how would you describe the role that the government needs to play in this, Tim?
Thank you, Alan. Thanks for that nice introduction. Government in this space, probably the most valuable role that it can play is twofold. First, it's to lead from the front and not from the rear. And secondly, it would be to exemplify best practices in how one goes about, on the sell side, accessing this market in a way that's responsive to what investor needs are and which anticipates what investor preferences and taste will be. And on the buy side, to be very clear and direct in communications of what the expectations for such investments are. Now, I hasten to point out that in the kind of investment we do in the State Treasurer's Office, this is not what one would call patient capital. Quite the opposite. This is impatient capital. This is money that's being invested for very short terms, pending disbursement by other units of the government. So we don't get to be real picky about green investments and environmentally responsible investments back there because we don't have the luxury of being able to identify long time horizons on which to see results. But on the sell side, where we sell the state's bonds, and the state treasurer is responsible for selling essentially all state bonds issued by the state and her agencies, not by local governments, we have abundant opportunities there to start parsing these out into green. Now, when I said lead from the front, not from the rear, that brings me to the problem in a big state government. California will often sell, and just did several weeks ago, more than $2 billion worth of general obligation securities. And in that particular offering, we had literally thousands of individual projects that were being financed. So it is not only possible, but highly likely that there were significant green projects in there. But as a state government, we haven't yet quite figured out how to parse them so that you can attribute a green project to a particular bond. But we're working on it, and in fact have done it back in 2014 and anticipate we'll do it again in 2018, later this year.
Ms. Barnes, same question. What do you see the role of government, the iBank in particular, and government in general?
Right. I would agree with Tim on the leadership role of the government agency, but I also think that government serves a unique role as a facilitator to communities that would not otherwise have access to financing for the projects that are really going to be meaningful for a long-term sustainable efforts towards meeting the 2% goals. iBank in particular, we issued in February $445 million of green bonds for the Clean Water State Revolving Fund for the State Water Resources Control Board. And those bond proceeds are going to be used for identified wastewater projects that are certainly green and have an effect on climate. iBank also, and those, that financing is different in that a lot of the financing, those loans that will be made at very low rates, at 1% or slightly higher. And I also believe there's also a grant program in there. And so these funds are earmarked more for communities that some folks call them underserved, disadvantaged, low wealth communities. I think of them as communities that if they were go to the traditional commercial market for financing of their projects, the costs would be higher. And we're talking about financings to governmental cities, counties, joint power authorities. But they have, as I think you mentioned, there's $100 trillion worth of infrastructure need in this country and in the world. Well, California is the sixth or seventh largest financial entity in the world. And so we play a major role in that regard. So I see the state as a facilitator. iBank in particular, we facilitate direct financings to communities that would not be able to get financing themselves at the cost that iBank provides. We provide subsidized interest rates. We look at the unemployment rate in the community, and we provide a subsidy off the rate if the unemployment rate where the project is being financed is higher than the state average. We also look at the median household income, and likewise, if the median household income is lower than the state average. And just looking recently in the last couple of weeks, I was looking at our overall portfolio, and 80% of our portfolio goes to a disadvantaged community. So I see the government filling the gap, the hole that a traditional lender would not necessarily finance. And also our financings are up to 100% of the project and could be up to 30 years. Another reason why there's a gap. So we're a facilitator to help provide access to the low wealth communities.
Before we go forward, Mr. Schaefer, I'd like you to do one thing, because I'm not sure everybody understands. Can you define, let's get our terminology down. When we talk about a green bond, can you describe in about a minute or two what we mean by a green bond and how it differs from a plain old vanilla security?
Sure, be happy to. And sometimes it's pretty subtle. There are many folks that argue that a very significant number of bonds, which are debt securities. This is just your government borrowing money. Don't make it any more complicated than that. That a significant number of governmental bonds are already green. And in fact, that might be true. But the strictest construction of the phrase is a borrowing by a governmental or a private entity, the proceeds of which will be used for a project which produces environmental benefits. It cleans water, it reduces greenhouse gas emissions, it remediates environmental challenges in its jurisdiction. It serves a purpose which reduces the demand we place on the atmosphere from tailpipe emissions. So it can have a fairly broad, interpretation. But to borrow from a Supreme Court justice who couldn't define obscenity but knew it when he saw it, you generally can define. You can know a green bond when you see it because it's trying to do something that is environmentally responsible. Now that includes in the governmental sector doing things that would potentially harden or improve the likelihood that that governmental agency, which owns assets on behalf of the public, were it to be exposed to rising seawater, for example.
Right. We often hear the term P3s, public-private partnerships, where the government gets involved and they have a private sector partner. And as I started this conversation, we talked about $100 trillion, and that is going to require private capital. Ms. Barnes, can you describe the role of how the government can help private partners to finance various projects that we would like to see financed?
Yeah, I just was at a P3 conference on Tuesday, so it's timely. When you're thinking of a P3, and just to define it, it's the public-private partnership. It's the public aspect of the project that comes first, not the private. It's that there is a need in a community for some project to be had. And the question becomes, the nature of the project, what are the risks involved in the project? And I think of the P3 scenario as, in looking at design, bid, bill, how do you do the procurement? Who is going to take the risks associated with the project? Where is the ownership going to be of the project? Is it going to be a lease? Is the the public sector going to maintain the ownership of the project? What are some of the construction risks involved? Who's going to be responsible for that? So when you think of P3 projects, and say you've seen a P3 project, one P3 project, you've just seen one particular P3 project. I think it's not something that you can define the same way for every project. It's really about the public sector identifying the project, the risks associated with it, and which aspects of that risk do they want to bear, and which aspects do they want to have someone else bear for a price.
Mr. Schaefer, Ms. Barnes just discussed the ability in a P3 project to reduce the risk to the government or to the private sector, which is also going to reduce the cost of capital. Can you describe some of the various roles that it can play, such as credit support, first loss, et cetera, so that laymen will understand and how this can be used to leverage money?
Sure, I'd be happy to. Both the California I Bank and the state treasurer administer programs that do that kind of thing. The simplest way to explain it, I'm assuming I'm not talking to black belt financial professionals here, so you black belts can tune out and look at your phone while I talk. Credit, when extended by any lender, whether it's a bank or somebody who buys bonds, is quite unlike stock or equity. Remember that in a credit situation, if you lend somebody money, you being either a holder of bonds or a big bank or whoever, when you lend somebody money, your maximum upside is that you will get repaid your principal on time and as agreed, and you will get paid the interest that the borrower has obligated herself to pay to you on time and as agreed. If that company or that municipality or that state or that sovereign nation blows the lights out economically and performs way above expectations, you still get your principal and your interest. That's it. Now consider the flip side of that coin. If things don't go well as a lender, what do you get back? Well, you may not get back all of your principal, although in governmental lending, that tends not to be quite as risky as it is in the private sector. But you may not get it on time. And equally important, you may not get your interest either in its entirety or on time. That's where the big risk is in governmental borrowing. Now, what some of these credit support programs do is they go to a lender and say, if this project, for some reason, can't pay you interest on time, there is a source of money here which will mitigate your risk. And if your risk is, you as a lender, if your risk is mitigated, you will have a strong tendency based on the economics to charge that borrower less because the risk has been attenuated by virtue of having somebody else sharing in it. These kinds of programs exist in a wide variety of shapes and sizes and colors throughout our nation and throughout the world. So a loan loss reserve, for example, will say to a lender, we have a pool of money here, and if 4 of you have borrowed money from that pool and one of you can't pay, there will still be some money left here. And the one that can't pay, we will backfill from that. So it becomes a risk pooling device, if you will. Loan loss reserves, first losses, overinsurance, reinsurance, those all fit into that category. Then there is the more familiar one, which is the direct guarantee program. Anybody in this room have adult children? I do. I'm very familiar with direct guarantees since I signed the mortgage for one of my children. That's a direct guarantee. If she can't pay her mortgage, the bank will call me and ask me to perform. Okay.
Ask being a very
I'm sorry?
difficult. I said ask is a polite way of saying they're going to demand it.
Yes, exactly. Yes, exactly. So hope that helps. Does that answer your question,
Yes,
Alan?
it does. Ms. Barnes, Tim used the term leverage. We think about, and I've, years in state government, the frustration, and I just, you guys you're all familiar with the GHG fund in California, which produces about $3 billion a year. And there's about probably $50 to $100 billion of asks for it every year. So nobody gets what they want out of that. One of the ways to look at it, because traditionally they use it as grants. This gentleman has a project, he comes forward, he wins, and we give him a certain amount of money to do his project. Another way of using that money would be to leverage it, using some of these programs that Mr. Schaefer just talked about. Ms. Barnes, can you describe in the financial world how leverage works and how those monies could be used to leverage, probably the wrong use right there, but to give us more projects than $3 billion worth if we were to use the money as leverage.
Right. Well, the Greenhouse Gas Reduction Fund, which Alan just referred to, iBank actually has an ask as part of the governor's cap and trade expenditure plan we've requested in this year's budget, I guess for next year, to receive funds and to use the funds in the California Integrated Climate Investment Program. And we have discussed various ways to use those funds. One way to use those funds to leverage would be to take those funds, make direct loans, as I had described earlier, to a city, for example, and then take that loan that I have, that 30-year loan with principal and interest payments, and treat it as an asset that I pledge to revenue bonds that I issue to retail investors and institutional investors. And then when I pledge that loan, depending upon the interest rate and my rating from the credit rating agencies and what's going on in the market, and the amount of equity that I have, I may be able to leverage that, what are we calling, integrated climate investment from GGRF 3 to 5 times. I know other states talk about leveraging up to 10 times, but I want to maintain the quality of the rating of our paper, because that higher rating on our credit quality on our paper means our cost of funds is lower, and I pass on that benefit as subsidies to my borrowers. Another way to leverage it is, so I've given the legislature many different ways to consider giving me this money. Another way to leverage it would be, as Tim mentioned, to establish a reserve fund that would be an incentive to traditional lenders to lend, where we would guarantee 50, 80, 90%, they need to have some skin in the game, of the loan. So there may be a financial institution out there that would not make this loan without a guarantee, but if they had an iBank guarantee for 80%, they may be willing to make the loan in that instance. I haven't necessarily found them to lower the interest rate, although that would be a good thing, but it at least leverages, and then on that, say I have $100 million, right now we leverage about 4 to 5 times. So I could take 20 to 25% and set it aside for that loan instead of 100% of a set aside. And that way I have more funds available for more financings, either directly by iBank under our bond program, or through our credit enhancement with the guarantee to a direct lender.
Good. So we've now set up the criteria that we can use for issuing green bonds as a way to get private money involved in this. There's a clear market out there. Had you talked to me 2 years ago when I first started looking at this, there was really a question whether the problem we had, European markets, Asian markets are growing faster than the US market. And there was a question that we had, which was, and we're going to get to some studies that the Treasurer's Office had done by NACW for them, was whether it was a supply and demand issue. Was the problem that we didn't have, that there wasn't demand out there, that there weren't investors that wanted to buy green labeled securities, or was it a supply issue? Didn't we have enough? That question's been answered. Okay? Every green bond issue that has gone out from both the public and private sector over the last year has literally been oversubscribed the moment it hit the market. There is clearly an investor class out there that wants to invest in green assets, that is in this for the long game, and understands that investing in companies with stranded assets is far more risky in the long term. So the question comes down then, as we look at these green bonds, what are the standards? I'm going to set one more piece before I ask the next question, which is keep in mind that if the Treasurer's Office issues what I'm going to call a vanilla bond, the only analysis they have to do is the credit. Okay, is the project going to pay for itself? Are the people of California, are the taxes going to pay for it? It's a very somewhat simple analysis. When you do a green bond, you got two other steps. Number one, you got to define what's green, and I'm going to ask Mr. Schaefer how we do that and who does that. And the second issue, which if I talk to what I call the green eye shades folks at the Treasurer's Office with the MBAs upstairs, they're going to say, look, if I issue a vanilla bond, when I sell it, I'm done. Okay, doesn't matter. Once it's done, it's out there. Green bond, the question comes down to, does it do what you are claiming it's going to do, which comes to post-issuance compliance. You got to follow it. If they say they're going to build a wind project, do they actually build a wind project? If they say they're going to build a wastewater facility, do they actually build it? So, Mr. Schaefer, the question then goes to you. What is a green bond and who defines it?
Well, it can be defined in two very different ways, and there's a lot. This is not subtle when you're in my business. The first way is to go to a third party and have and lay your books open and say to the third party, remember we talked about a bond issue is a borrowing, the proceeds of which are going to fund a project which has environmental benefits or which hardens the community. So you can take that individual list of projects, and in a big state like California, as I mentioned, we can sometimes have thousands of them within an individual bond issue. And you say to the independent third party, who has established standards by which they will look at the quality of the projects and say, we want you as a third party to verify that these projects in fact are accomplishing the environmental goals that we claim they are, and then we want you to put your stamp of approval on this so that the lender, the buyer of the bond, can then confidently say, the money I just invested is invested in something green. The story doesn't end there, it starts there. The second way you can define what's green is through a process of self-certification, where the issuer, the borrower, says to the lender, trust me, I'm doing green things with this. Each of these approaches is in use as we speak. Each of them is. Now, part of the challenge is in that first instance, and now I'm going to move into editorial, and I will disclaim it as such. In that first instance, the verifier or certifier of the green bond has said, now I want you to do certain things to report to me once you've gotten the money and you've begun dispersing it, then in fact you are really doing that. In the second instance, the issuer, the borrower, will say, trust me, I am. Some investors are willing to do the first, but not the second. Some investors are willing to do either, depending on who the issuer is. And that's where we find ourselves in 2018. There is not a hard and fast rule, although this is the editorial part. It appears to me that we are very much headed in the direction where somebody independent is going to have to do the verification.
Ms. Barnes, do you have anything to add to that?
Yes. So we issued 445 million green bonds in February for the Clean Water State Revolving Fund. We identified in the official statement a list of the projects that would be financed with those bond proceeds. We identified it as a green bond in our name, and we, in the disclosure documents, disclosed what types of projects would be financed. I think that there are different ways to look at green bond financings. Most of the governmental agencies that I've worked with that issue green bonds or could issue green bonds are limited in the types of projects of what they can do. You know, the Clean Water State Revolving Fund can do wastewater. There could be a drinking water fund. There can be, so if you're limited in what you're doing by statute and you stay within that and those parameters, because you don't have authority to go beyond those parameters. You don't have authority to finance a project that's not a clean water project, right? So by definition, in that context, your financings have a positive environmental impact. And Tim's definition earlier, I agree with. That's the definition that we follow. We follow the green bond principles. And it's not, we don't certify the bonds, the projects as being green. We disclose what the projects will be. So maybe I actually think on some level that might be, given the securities laws, a higher level of notice to the investors as to what we're doing. So in February, we listed the projects, and then as a post-issuance matter, and following the green bond principles, once those financings take place, they will be listed on our website as having been done, financed. And then we will also do an update of those projects to IMA, to the SEC on an annual basis until those funds are exhausted. I think where we were offered verification services, assessment and verification services from a variety of very competent and credentialed entities. But we didn't see a need to get someone else to tell us that the clean water SRF bonds were green bonds. We didn't see a value added to paying for that. And then the thought is, if we pay for it this year, do we have to pay for it each year thereafter? Have a verifier or an assessment done every year? And again, we didn't see the value added for paying for that for this particular issue of bonds. That being said, I could very well see a time and a place and a structure and a financing where the makeup of the portfolio is not as clean or green, and there might be different levels of green, light green and forest green, and we can make up a bunch of different words, but that it might indeed make a difference to an investor. So sometimes it's like that famous court case, you'll know it when you see it, right? But sometimes it's not as clear. And in that case, I can see a need for an assessment to be done and a verifier to be the appropriate thing. What I ask is that, and even though I'm in government, that we not assume that all transactions are the same and look at them on their individual basis. So I don't want to get to a point where all green bonds have to pay for an assessment or a verification, even when it's a drinking water bond.
You raised a really interesting issue, the shades of green issue, okay? To that end, I mean, there are, here in San Francisco, just as an example, last year, San Francisco Public Utilities Commission, which runs a small project known as the Hetchy project, to give the city of San Francisco both its water and its power, sidebar, damming half of a national park to do so, but that's an editorial comment, reissued bonds for a seismic retrofit. Important stuff, okay? Labeled them green, self-labeled them green bonds. You get two issues involved in that issuance. Number one is the issue of additionality. Was there additional carbon being saved? It's a hydro project, large hydro project, which in itself can be controversial, but this project is 80 years old. Okay? There's no additional environmental damage being done by the project. But the other part of that is there's no additional carbon being saved. The project already exists. So the question that comes down to, would it be valuable in the market to have an additional metric that would indicate how much carbon is being saved by a project? The dark green versus light green argument. Mr. Schaefer, do you have an opinion on that?
I'm not sure I have an opinion as much as an impression of what I think is going to happen. And to create context, I need to divert you for just a few seconds. As we sit here today in the U.S. governmental bond market, there's about $3.8 trillion of outstanding governmental debt. That's not the federal government, that's state and local agencies through the United States. And of that 3.8 trillion, about 2/3 is owned by either households, which is an amorphous term. It's not the same as our individual households because it can also include family offices and small family trusts. It can even include hedge funds under certain circumstances, although they tend to be small. And the big kahuna, mutual funds, who are typically investing on behalf of individuals and or households. So as to the shades of green, individual investors are not yet expressing preferences for that, dark green versus light green. However, there is a perceptible pattern, not yet a trend, but there's a perceptible pattern that certain of the mutual funds are expressing by what they buy, a preference for darker green paper because it's easier for them then to communicate that to the shareholders on whose behalf they're making that investment. There's less room for judgment error about how green something is. So I'm not sure I have an opinion about where it's going to go because I do think it's evolving.
Ms. Barnes, same question?
So I have sort of the same sort of hunch that Tim alluded to, and it comes from my belief that there will be a disruptors in the investment market, and it's already started to happen where there have been, last year there were some bonds issued and they were purchased on an app. And so as more and more folks that are my son's age or they're in their 30s are thinking about their investment and their retirement, and my son thinks of banking only in terms of his phone. I don't know that he has been in a brick and mortar financial institution in years. That for this demographics that's coming up, and as we change, as our children change and they teach us how to use these things, I think there will be more of a demand for different qualities of green in the future. I don't know it for a fact, but I believe it's coming, and that's why I think, depending upon the pool of assets, there may be a need to have a verifier as to what level of green, so you can put it on an app and people can then make an easy determination. It's still a disclosure issue,
Yeah.
but
Ms. Barnes, that's a wonderful segue into the studies that the Treasurer's Office had commissioned from Natixis. Mr. Schaefer, can you share with the audience some of the findings? Because Tim and I worked together at that point in time, and we signed a contract with Natixis to tease out some things. What the treasurer had done is we had taken some anecdotal information. We'd had meetings in San Francisco, Boston, and New York with various financial players, and had kind of gotten a narrative sense of where the market was going, at which point Natixis was hired to give us a more substantive metric. And I'm going to have Mr. Schaefer describe what that survey determined as to the direction of the market.
Okay, I'll try to compress first for you amateur statisticians out there. I didn't see anybody nod when I said that. The sample size was 500 investors. It was conducted over a 2-month period. So the data that I'm going to give you are based on the law of large numbers and a tight enough longitudinal horizon that we don't think we built in longitudinal bias into it. Here's the first thing we learned. Of the 500 investors surveyed, these are California investors now, 53% said that they were familiar with the concept that investments can have an environmental or social impact that's positive, more than half. 29% knew what green bonds are. Okay, now we're about to get to the confusing part. But only 13% have invested in green bonds. So why is that? And the study went on to try and tease that out. It appears to be age-related. Tavia's kids, because she was a child bride and I was an old guy when I started, but we have children about the same age. And I have kids who their financial world is on their phone. And not surprisingly, that's what we learned when we took that 53, 29, and 13 and started started decomposing it and unpacking it. That in fact, many of those younger investors were the ones who fell into those first two brackets but didn't buy green bonds. Why is that? Well, that's because people at the early stage of their lives, this comes from a 50-year investment professional, frankly shouldn't be buying a lot of bonds. They should be invested in equity securities that would participate more in the economy. So that's one of the tantalizing figures in here, is that you expect that those younger investors, more connected, more technologically savvy, they show a clear preference in the survey to investing in things that are socially responsible, including green, but they're not yet there in their life story that those numbers are rising. But just as I grow older every day, Tavia and Alan don't, but I do, so too will these kids. And as they get closer to their retirement, they will end up more active in bonds, because if you just unpack the demographics of who owns governmental bonds, it skews very much to my generation. That's just a function of where we are in our life. The last thing I would offer that I found really surprising in 2018, and I don't want to be careful, I don't want to make any political statements here, but the study asked, who would you trust to give you information? We talked a few minutes ago about self-certification versus third parties. So 74% of the respondents said non-financial reporting is important when evaluating green investments. Good, that's fairly predictable. 72% said greater transparency and standardization would increase their desire for green bonds. Great. Only 60% said, but if you give me both of those things, I will pay more, or charge the borrower less for a green bond. Then the punchline came. Who do you trust to give you all of that data? In decreasing order. 58% said the news media. So if you're a media person, I guess that's good news, okay? Especially in light of the last few months. 47% said they would trust issuer reports. 45% said they would trust their financial advisor, and this stockbroker, Reed Stockbroker. And only 44% said that they would trust third-party ratings. Now there's the riddle. That institutional audience wants those third parties because they want to offload it, and yet the investor herself says only 44% of her numbers said that they wanted that third-party rating. That's what I meant before when I said I think we're still at sea on some of this.
Ms. Barnes, you have any?
No, I'm surprised by that, that answer. Although, when looking at the, I said when I talked about the verifiers and that the ones that approached us were credible, and they truly were. I often think about who's going to verify the verifiers, and so I have. Where's that oversight, and is there going to be a standard as to how much is forest green and how much is lime green? And maybe, and I'm just basically thinking out loud and brainstorming with you in real time right now, maybe that's what the demographics are saying, that they're not confident yet that that's a reliable source of information yet.
One more question. This is a very kind of it's an interesting one. Up until now, for all of you, I mean, we're somewhat preaching to the converted here. I mean, this is, you folks wouldn't be here if you didn't believe climate change was real and a real threat, and particularly in this seminar, you are going, how do we finance this stuff? But up until now, it's all been about mitigation. It's how do we stop this from happening? Well, here's the reality. I've been this morning and they were talking about the increased hurricanes, and polar bears ending up, I think, in Toronto or something now. It's happening already. This isn't anymore. I mean, when I first started looking at this issue, I used to teach at the University of California. If you go back to my lecture notes from the mid-90s, climate change was about this much. There's a theory out there. We think it's happening. The data, there's still questions on the other side. How severe is it? When's it going to happen? And it was, this is going to happen somewhere mid-next century. Well, unfortunately, that was, so in teaching it, you went the middle ground. There's some scientists who say this, some people say this, and you went quarter down the middle. Well, the unfortunate part is, you look back to the scientists in the early 90s, those on the more radical end of this thing have turned out to be right. The glaciers are melting faster. The storms are more severe. Do understand that 2 degrees centigrade, that's a political number. The scientific community, I think it's actually much, much lower than that, and we've already loaded the atmosphere with a large amount of that carbon. So the next question, which is a lot harder, I just returned from a conference in London that was about mitigation and adaptation. We need to pivot now. It's already happening. How do we finance the infrastructure, and how do we have the conversation about mitigation while still talking about how do we protect low-lying areas? How do we deal with the infrastructure that the state needs? And can we build infrastructure that is resilient going forward? And how do we do that? That's a series of questions. Let me start with you, Ms. Barnes. You work for the State Infrastructure and Development Bank. How do we do this? Is it asset-backed securities? What do we do to finance the infrastructure we need? Now, granted, the great brain in Washington is going to solve this. He's told us he is. But since we don't have that great brain here, Ms. Barnes, right, what would be your recommendations for how we do this?
So, well, the Governor Brown and his administration thinks that we need to, in moving forward and in preparing for the climate summit in the fall in the city in San Francisco as a response to the United States pulling out of the Paris initiative, is that we recognize that projects need to have at least 2 components, if not more, but at least think in terms of reduction of greenhouse gas emissions, but also climate resiliency. And unlike some folks, we don't believe we have all the answers. We believe that there's a need for a summit and a need for bringing different stakeholders from around the country together. So the governor is convening a group of experts and stakeholders to think about this thing and to offer to iBank and to the state ideas about how not only do we do the financing, but what are the different methodologies for leveraging it. Because we're not going to be able to have enough money in the state to do it alone. It's just too much. We have to be able to leverage it with private capital to even begin to make any inroads on the goals for 2%.
Mr. Schaefer, short answer to the same question before we turn to questions from the audience?
Okay, short answer to the same question. Some of you have probably read the famous Joseph Heller book, Catch-22. And there's a line in there. Of course, the problem with Catch-22 is that there are no simple answers to things. There's a line in there, an exchange between Major, I believe it is, and Upremian, where he says, "Why don't we buy our eggs in Malta?" And the response is, "Because we've never done it that way before." And that's what I was trying to get to when I started this conversation, when I said you have to choose to lead from the front. We can't continue to finance the public infrastructure that we finance based on the same mentality we had in the 1960s when we started to finance it. You need to break the back of that. That means you need to lead from the front and say, if on behalf of the people of California, we're going to go out and take on a whole lot of debt to fund whatever that infrastructure project is, we can't think about it like we did in the 1960s. It now has to be resilient. And our investors are going to start demanding that, because when we borrow, we tend to borrow for 30 and 40-year terms. And some of these effects are going to be very real during that 30 or 40-year period. Smart investors know that, and they are challenging us every day to say, what are you going to do about that? That's why you see the governor convening this conference that he's putting together this fall. My boss just got through doing a 2-day soiree down in Santa Monica with people that Tavia was part of, to talk about this kind of green finance. And then I'll end with this thought, because you asked me to be brief, and I'm doing my best. We had a climate scientist at our event at the end of February. And I know this is an imperfect metaphor, but please be patient with me. He said, let's just assume for the moment that there's a 20% chance that we're wrong, and that 2 degrees Celsius is going to be a lot sooner. Then he put up a picture of an airplane on the screen in front of the audience and said, would you let a loved one get on this plane if there was a 20% chance that it would crash? Now, that kind of puts the pickle on the fork, doesn't it? So that's why we must start right now by stop with this. We don't buy our eggs in Malta because we've never done it that way before, and start thinking about it today in a way that keeps us resilient for the future.
Questions? Have any questions from the audience? Yes, sir. Why don't you get the microphone?
Thank you. So tell me what the advantages to an issuer are of issuing green bonds. It seems like it's a lot of trouble to put the package together. Then you have to deal with compliance costs afterwards. And I've been asking investment professionals, are you willing to accept a lower rate of return on a green bond than a conventional bond? And I keep hearing, well, no. So what's in it for the issuer then, if not a better, a lower rate of interest?
So I think it depends upon, in the first instance, the credit quality of the issuer. So I haven't iBank has not experienced a differential because our bonds are green at all in the pricing. But I understand that throughout the country over the last 5 years, there have been issuers who have seen a price differential. Maybe it's only a couple of basis points, but some price differential for green bonds. iBank, our bonds are AAA rated. They're already low. The investors are already complaining it's too low. They're not going to go any further down. But the benefit for us is saying to the market and saying that in California, doing things that have a positive impact to the environment, you can call them green, or a positive impact on climate. You know, I could also see a time, Alan, when we have climate bonds, right? Climate impact bonds, that it's a way to message to the market that this is important to you. And we have found that the compliance is not burdensome because we follow the green bond principles. We have no problem listing the projects. And this is where you have, you know, a mono type of projects, right? Clean water SRF, or drinking water, or environmental mitigation, whatever. But that in that context, it's really not that much more difficult to add it to your website and disclose it on IMA. And we actually disclose the list in the OS. So it's just a matter of once the things we've listed in the OS have closed, we put it on the website. So we haven't found there to be a burden at all on the compliance side. And it's really more a messaging to the market of who we are and how we view ourselves.
I'm going to add a little bit to that. What the data indicates to us right now is that in the primary market as a whole, there's no differential. You don't get any advantage by going green. However, there is starting to be, not yet sufficient to make a broad statement, but starting to be evidence that in the secondary market, there is an advantage of 10 to 25 basis points. And as the evidence of that grows, what you're going to see is that there is going to be I won't say a flood, but there's going to be a lot more demand. And the other thing, as we said, is right now green bonds are being snapped up. They go out and they are oversubscribed almost immediately. When they're then traded on the secondary market, we're starting to see advantage. Next question. Yes, yes, right there.
Hi, Julie Kelleher, 3 Degrees. I saw a headline to an article last week, and it was talking about how they have green loan principles, much in the same way as they have green bond principles. And in classic millennial fashion, I did not actually read the entire article, but I'm just wondering if you guys can talk about if you've seen green loans come up in any market talks or anything like that.
This is the first time hearing it.
I've never heard the term before. Tim?
One of the things that I would just ask you to be aware of going forward, I have the privilege of representing the treasurer on one of these global boards, the Climate Bonds Initiative, for their standards board. And one of the things that's under active discussion right now is going to run to your issue, and that is there any additional gain to be had by expanding her horizon and talking about assets that are green rather than the instrument that finances it, so that a private lender can lend to a green asset and gain some of the same benefits that she would if she were buying a bond in the securities market. So that's a conversation that's developing as we speak.
I think we're out of time. I'm going to leave you. I'm sorry. I'm going to leave you with one last thought. As I said, I just returned from a green bonds conference in London. It was raised there, if you go back about 170 years, in the end of the 1830s, a small ship sailed up the Thames, a ship called the Beagle, with a gentleman named Charles Darwin on board. And Charles Darwin has several years to write a book based on his findings. And when Darwin first issued the book, it wasn't like everybody just said, you know, 1,800 years of religious history is wrong. We all agree with you. We're descended from apes. But over the next 25 to 30 years, as origin of the species became known, the entire way that the world thought about our origins changed. I propose to you that in the world of finance, you are trying to make as big a change right now as Darwin made with the origin of species. That money, that capital that is invested around the world has got to be spent on preserving the planet. I'm old, I'm gonna be done before all this stuff, but I got kids. And the world that they grow up in is gonna be very dependent on whether the folks in this room and all the various conferences go out and spread the word. That capital has to be invested in a different way, that the way we have done it in the past, the way we have thought about it in the past, is no different than the way people thought about the origin of the human race prior to that. With that, thank you all very much. Thank our panelists. I hope this has been informative.